Well, good to see you. Pull up a chair. I'm an old fellow now, 94 years young, and I've been at this investing game for a mighty long time, longer than most folks have been alive, truth be told. I remember a time when the world moved a bit slower, when a dollar felt like a dollar, and when a fellow could buy a newspaper for a nickel. Things change, but a lot of the fundamental truths about business and investing, they don't budge. They're as solid today as they were when I was a boy in Omaha delivering papers. Let me tell you, I've made my share of mistakes over the years, plenty of them. Some were little bumps in the road. Others were big, boneheaded blunders that cost us millions, sometimes billions of dollars that could have been put to better use. One that always sticks in my mind, a real head scratcher, involved a shoe company called Dexter Shoes. This was back in 1993. Now, you'd think a shoe company, that's a pretty simple business, right? Folks always need shoes. And we had some good experience in textiles and retailing, so it didn't seem too far outside our circle of competence. But, oh boy, was I wrong on that one. We bought Dexter Shoes for $433 million. That sounds like a big number, and it was. But here's the real kicker. I paid for it with Berkshire stock. That's something I almost never do because I think our stock is worth more than most folks realize. But I thought Dexter was a fine business, a well-run operation with good management, and I was willing to part with Berkshire shares for it. In hindsight, that was probably the dumbest mistake I ever made. Not just because the business went south, which it did, but because of what those Berkshire shares are worth today. You see, those Berkshire shares I gave up would now be worth, well, many, many billions of dollars. More than 5 billion, certainly. It was a staggering sum of money that could have compounded for our shareholders. I was too foolish to understand that Dexter, despite its apparent stability, had no durable competitive advantage, no moat, as Charlie always says, foreign competition, cheaper labor, changing styles. It all came crashing down on them. I misjudged the economic landscape entirely. What looked like a simple, understandable business turned out to be a trap. I kept throwing good money after bad for a while, too, hoping to turn it around, but it was just a slow, painful bleed. I often kick myself for that one, thinking about what those shares would be doing for our shareholders today. The big lesson from Dexter and from other textile mills we owned before it was simple but powerful. Always invest in businesses with a durable competitive advantage, a moat, something that makes it tough for others to come in and eat your lunch. Ben Graham, my old professor at Columbia, taught me about margin of safety, about buying a dollar for 50 cents. But it was Charlie Munger who really opened my eyes to the importance of quality of a wonderful business. You see, a fair business at a wonderful price might seem like a bargain, but a wonderful business at a fair price will make you rich beyond your wildest dreams. A terrible business at any price will just drain you dry. What's a moat? Well, imagine a castle. It's got walls, sure, but a really good castle has a wide, deep moat around it, full of alligators and nasty stuff, making it hard for invaders to get in. In business, a moat can be a powerful brand like Coca-Cola. People have been drinking Coke for generations, and they'll keep drinking it. It's got a place in their hearts and their habits. It can be a cost advantage, like Geico, which for a long time could offer lower prices on insurance because of its direct marketing model. Or it can be something like See's Candies, where the taste and the tradition create such a strong emotional connection that people are willing to pay a premium. These are businesses that are tough to replicate, tough to disrupt. When we bought See's Candies back in 1972, it was for $25 million. Charlie and I had a long conversation about it. We thought it was a good business, simple, straightforward. But what we learned after owning it for a while was just how strong that brand power was, particularly in California. It didn't take much capital to grow, and it generated a lot of cash. To date, See's has delivered over $2 billion in pre-tax earnings to Berkshire. Imagine that, a small candy company generating that kind of value. It taught us that sometimes these seemingly small, simple businesses with strong brands can be absolute gold mines if you understand their competitive advantage. It's not about the complexity of the product, it's about the simplicity of the underlying business model and the strength of its moat. Another great example, one that almost got away from us, was American Express. This was way back in 1964. They had gotten into a mess with something called the salad oil scandal. A warehouse full of what was supposed to be salad oil turned out to be mostly water. American Express, which had lent money against this supposed collateral, was facing huge losses and a real crisis of confidence. People were questioning whether their credit cards and travelers' checks were safe. The stock plunged. Everyone was selling. Fear was rampant. And remember, I went to visit their offices in New York, and then I went to their warehouse to see what was going on. I sat in a restaurant downstairs from their offices and watched people queue up to buy American Express travelers' checks, even in the midst of this scandal. And I saw people using their American Express credit cards. It was a real world demonstration of the trust and loyalty people had for the brand. It showed me that the underlying business, despite the temporary setback, was incredibly strong, with a powerful moat built on reputation and utility. We poured about 40% of our partnership's capital into American Express at that time, somewhere around $13 million. It was a huge bet, but it paid off handsomely because we understood the fundamental strength of the business and its bond with customers. So what does this mean for a young investor today? Or for anyone for that matter? It means you need to think like a business owner, not just a stock picker. When you buy a share of stock, you're buying a piece of a business, and you want to own good businesses. You want to understand what makes them tick, what makes them special, and what keeps competitors at bay. You don't need to be a genius to figure this out. You don't need fancy algorithms or high frequency trading. You just need a clear head, some common sense, and the patience to let things play out. Don't get caught up in the daily gyrations of the market. Mr. Market, as Ben Graham would say, is a manic depressive fellow who shows up at your door every day offering to buy or sell his share of your business at a crazy price. Sometimes he's ecstatic, offering you a high price. Other times he's terrified, offering you a ridiculously low one. You don't have to listen to him. You just thank him for his opinions, and you use him only when he offers you something advantageous. Be fearful when others are greedy, and greedy when others are fearful. That's not just a cute saying. It's how you make money in this business. A shareholder once asked me, Warren, what's the one thing you tell your younger self about investing? I'd tell myself to focus on intrinsic value always. Understand what a business is truly worth, independent of what its stock is trading for, and then buy it for less, much less if you can. That's the margin of safety Ben Graham pounded into my head. It's like building a bridge that can hold a 30,000-pound truck, but you only ever drive 10,000-pound trucks over it. You want that extra cushion, that protection against the inevitable bumps and surprises life throws at you. This applies to any business, not just investing in public stocks. If you're starting a small business, a local bakery or a hardware store, you wouldn't just open your doors and hope for the best. You'd think about your customers, your competition, your costs, what makes you unique. You'd figure out how to keep people coming back. That's building a moat. It's the same principle whether you're buying a global corporation or a local diner. The fundamentals don't change. What really matters in business is finding an enduring advantage, managing your capital wisely, and having good people around you. Good management is crucial, but even a brilliant manager can't save a bad business. I always say I try to buy businesses so wonderful that an idiot could run them, because eventually one will. It's a bit of self-deprecating humor, but there's a kernel of truth in it. You want robustness, simplicity, and an inherent strength that can withstand changes and challenges. But that's not the only lesson I learned the hard way. As another mistake that comes to mind, a relatively recent one that underscores a similar but distinct point about management and capital allocation. This reminds me of how, even after all these decades, the market can still teach you a thing or two, sometimes painfully. The next mistake involved something I thought I understood. A company I greatly admired, but where I misjudged the capital allocation decisions. Back in 2013 and 2014, Berkshire made a significant investment in Tesco, the large British grocery chain. We bought quite a bit of stock, building up a stake worth about 2.3 billion. I thought it was a well-run business, a strong brand in its home market. It felt like a solid, predictable business, much like a good American supermarket chain. However, I didn't pay enough attention to the competitive dynamics in the UK grocery market, which was getting tougher with discounters. And more importantly, I didn't adequately judge the capital allocation decisions of the management. The management started making some questionable moves, like expanding too aggressively, especially in the US, with their fresh and easy concept, which proved to be a real money pit. They were investing heavily in things that weren't working and weren't generating good returns. What I failed to fully appreciate was how management was allocating capital and whether those investments truly strengthened the business. By the time I realized the mistake, which was around 2014, Tesco announced some accounting irregularities and the stock plunged further. We ended up losing about 44 million on the investment pre-tax. That loss, while not as enormous in dollar terms as the opportunity cost with Dexter, was still a clear failure of analysis on my part. I sold our stake, took the loss, and wrote about it in my annual letter admitting my error. The lesson here wasn't just about moats, though Tesco's moat was indeed eroding. It was about paying close attention to management's capital allocation. Even a good business can be destroyed by poor capital allocation. Management's job isn't just to run the day-to-day operations. It's to wisely deploy the shareholders' money. Charlie always tells me, show me the incentive and I'll show you the outcome. You have to understand what drives management and whether their interests are truly aligned with shareholders. Are they buying back stock at sensible prices? Are they making smart acquisitions? Are they investing in high return projects? Or are they empire building and throwing money at ventures that don't make sense? It's a critical piece of the puzzle and one I clearly missed with Tesco. Over at Berkshire, we try to be very disciplined about how we allocate capital. We want to put our money into businesses that earn high returns on capital and have strong competitive advantages. We also seek out managers who are both talented and aligned with our long-term interests. We give them autonomy, but we expect them to act like owners, to treat every dollar as if it were their own. That's why we've had such success with companies like Geico. We bought control of Geico back in 1976, but I'd known about them since I was a student of Ben Graham's in the early. Ben Graham was on Geico's board and thought very highly of the company. I went down to Washington, D.C. one Saturday morning to meet Lorimer Davidson, who was then a rising star at the company. We talked for 4 hours and he explained the direct-to-consumer insurance model to me. It made perfect sense. They bypassed agents, saving a huge amount of money, and passed those savings on to good drivers. It was a massive cost advantage, a true moat. I went back to Omaha and put 65% of my personal net worth into Geico stock. That was a decision driven by understanding the business model and admiring the management's approach. Over the years, Geico has been an incredible engine for Berkshire. It just keeps chugging along, taking market share because it offers a better product at a better price to its target customers. That's the power of a durable competitive advantage and good capital allocation working in tandem. We didn't micromanage them. We let good people do their jobs, and they've done a magnificent job for decades. Now, look, people always ask me about the secret sauce, the complex formulas. The truth is, there ain't no secret sauce. It's really quite simple. Investing is not about having a high IQ. I've seen people with 60 IQs fail spectacularly because they couldn't control their emotions. It's about temperament. It's about patience. It's about being able to sit still and do nothing when there's nothing sensible to do. It's about being rational when others are being emotional. When I was running my partnership in the 1960s, I used to tell my partners that we weren't going to get involved in anything we didn't understand. We focused on value and at finding those dollars for 50 cents. We looked for special situations for companies trading below their intrinsic value, and we were patient. From 1956 to 1969, we compounded capital at an incredible rate simply by sticking to these basic principles. We weren't trying to predict the future or catch the latest trend. We were just trying to buy good businesses at fair prices and hold on to them. Think of it like baseball. You don't have to swing at every pitch. You stand there and wait for the fat pitch right over the plate. If you're a professional investor, you might get a few hundred pitches a day. Most of them will be outside your strike zone. You just let them go by. You don't get called out on strikes in investing. You only get penalized for swinging at bad pitches. That's a key difference from real baseball, where 3 strikes and you're out. In investing, you can wait for years for the right opportunity and no one cares. This idea of circle of competence is probably the most important thing Charlie and I have ever learned. You need to know what you know, and just as importantly, you need to know what you don't know, and then you stay within that circle for a long time. That meant we avoided most technology companies. I don't understand how their products evolve, how their competitive landscape changes so quickly. I like businesses where the fundamentals don't change much, where I can predict what they'll look like in 10 or 20 years. And now folks might point to Apple and say, Warren, you bought Apple. That's a tech company. And they'd be right in a way. But for us, Apple wasn't really a tech investment. It was an investment in a consumer products company with an incredibly sticky ecosystem and a powerful brand. People love their iPhones. They don't just use them, they live through them. That loyalty, that repeat business, that's a moat. It's a bit like Coca-Cola in your pocket. I understand consumer behavior. So while the product is high tech, our analysis was based on consumer habits and brand strength, which is very much within our circle of competence. We started buying Apple shares in 2016, and it has become one of our largest and most successful investments, a testament to the power of a strong consumer brand. My dad taught me a lot about integrity and hard work. He ran a stock brokerage during the Depression, and he always emphasized reputation. It takes 20 years to build a reputation and 5 minutes to ruin it, he'd say. That stuck with me. At Berkshire, we value integrity above all else. We want partners and managers who are honest, ethical, and who treat our shareholders' money as their own. It's why we've been able to build such a lasting enterprise. Trust is everything. I spend 80% of my day reading newspapers, annual reports, 10Ks, books. I just sit in my office in Omaha reading. It's how I learn. It's how I absorb information and let ideas percolate. Most of what I read doesn't lead to an investment, but every now and then you come across something that clicks, that sheds light on a business or an industry in a new way. It's not about speed reading. It's about deep understanding. It's about building up a reservoir of knowledge that helps you make better decisions down the road. Our annual shareholder meetings, where we have 40,000 people show up in Omaha every year, are a chance for us to talk directly to our owners. We answer questions for hours, Charlie and I, about everything under the sun. It's a way of being transparent, of explaining our thinking, and of reinforcing the long-term common sense approach we take to investing. We want our shareholders to understand what we're doing and why. People often think you need to be constantly active in the market, buying and selling, speculating, but actually the opposite is true. Our favorite holding period is forever. We want to buy businesses we understand that have moats, that are run by good people, and then just hold them. Let compound interest do its magic. Compound interest is the eighth wonder of the world. As Einstein reputedly said, it's astonishing what a relatively small sum can grow into over many decades if you just let it sit there and compound at a decent rate. That's how fortunes are made. not by trying to time the market or chase hot stocks. I bought my first stock, City Service Preferred, when I was 11 years old for $38 a share. It went down to $27, then back up to $40. I sold it, and then it shot up to. That early lesson taught me about the importance of patience and not selling too soon. I delivered newspapers as a kid, saved every penny, filed my first tax return at age 13. My investing journey started with those small habits, saving, understanding, and letting time work for me. When I reflect on the journey, starting from those early days on my paper route to forming the partnership, to taking over Berkshire Hathaway, which was initially a mistake, trying to save a failing textile business. It's a long and winding road. Buying Berkshire, trying to turn around that textile operation, ended up being a $200 billion mistake when you consider the capital tied up that could have gone into better businesses earlier. But it forced me to change, to pivot into insurance and other durable businesses. So in that sense, it was a valuable mistake. It pushed me to abandon the purely cigar butt approach of buying mediocre companies cheap and forced me to embrace Charlie's philosophy of buying great businesses. I still live in the same house. I bought in Omaha in 1958 for $31,000. I drive myself to the office every day. My office hasn't changed much in decades. I enjoy my cherry Coke, my See's peanut brittle, and a good hamburger from McDonald's. It's a simple life. You don't need a lot of fancy things to be happy or to be successful in investing. You just need a clear head, good habits, and the right principles. After 94 years of doing this, here's what I know for certain. The foundation of sound investing hasn't changed, and it never will. It's about owning a piece of productive enterprise, understanding what it does, and ensuring it has a robust, sustainable, competitive advantage. It's about ignoring the noise, controlling your emotions, and having the patience of a saint. Price is what you pay, value is what you get. Never forget that. I'm an old man now, and if I could tell young investors one thing, it would be this: learn to think for yourself. Don't outsource your brain. Read, learn, think critically, and build your own understanding of the world and the businesses within it. Focus on what you can control, which is your own behavior and your own analysis, not the short-term fluctuations of the market. I'd never bet against America. This country has an incredible capacity for innovation, for adaptation, for growth, despite all the challenges we face. The human spirit, the drive to create and improve, always finds a way forward. Invest in that future, in the businesses that serve human needs and desires, that improve lives. You don't need to be brilliant. You don't need inside information, and you certainly don't need to be an economics major. What you need is a sound intellectual framework, patience, discipline, and the ability to detach yourself from the crowd's emotions. Stick with what you know. Let compound interest be your friend. And remember that a great business, patiently held, will almost always reward you. As Charlie always reminds me, it's not rocket science, just plain old-fashioned common sense.